Hi, everybody. How are you? Hope you're having a wonderful, wonderful evening. Thank you so much for joining us today on the Startup Arena Pitch Battle. Thank you for registering. As registration to the Startup Arena Pitch Battle, we are giving this exclusive session on anatomy of a pitch deck with Pieter Kemps from Sequoia Capital. To give a little brief introduction on Pieter, Pieter joined Sequoia in 2014 as one of the first member of the firm's Southeast Asia investment team. He currently serves on the board of Fave, Nugget, Funding Societies, 90 Seconds, Health Engine, and Insider. He, before Sequoia, ran a couple of startups, worked in an incubator, also worked at Amazon Web Services, where he was responsible for Amazon's business with VCs, accelerators, and the broader startup ecosystem across Asia. So without further ado, let me introduce you to Pieter. Hi, Pieter. How are you?
Hi, Alyssa. I'm good. Thank you so much.
Hey, Pieter. So, we were talking backstage a little bit, you were telling me how many pitches you see in a typical day.
Yeah, I mean, part of the job obviously is to meet pretty much every day with multiple startups and have them go through their pitch or send stuff on email. So we're obviously seeing a lot of pitches from new folks, but also once we're invested, every follow-on round, if we do seed, we help companies with their Series A, Series B, Series C deck. And every time we work with them on their deck and we're trying to help them improve their story, and we hear feedback from other investors in terms of what's working and what's not. So lots of the conversations we'll have today is around those teachings that we had from ourselves, from other VCs, and from the work we do with our portfolio.
I see. Cool. That's super, super interesting. And we just as part of Search, we were actually helping out companies to pitch for their Series A round, right, Pieter?
Yeah, we have as part of Search, we have something called Upsearch, which is unlike many other programs where you have a demo day and only like 3 or 4 minutes to pitch. Our approach is slightly different, and we bring together like a very curated group of about 40, 50 investors, and we schedule one-on-one meetings. Most of the Search companies in Search 3 right now, next week over 2 days, we'll have between 15 and 25 meetings curated with investors that have shown interest in that specific company, that stage, that sector, etc. And so we're helping the companies prepare for that, and we're doing like what we call peer pitches, where there are other folks in the cohort give advice to each other, where we give advice and where we help them iterate and improve their story, so to speak.
Perfect. All right then. I'll pass the mic to Pieter. I'll pass the mic to Pieter to start then.
Thank you so much, Alyssa. Let me see if I can start sharing my screen. I'm just trying to share my screen. Let me see if that works. Yeah, I think you should be able to see my screen now. Is that correct? Lisa, can you nod and let me see? Yeah, all good. Cool, guys. So let's get going. Like this session, as mentioned, is called Anatomy of the Pitch, and we're gonna kind of like dissect what a pitch looks like and what we think is important and should be covered. Before that, very briefly, a bit about Sequoia and about Search. Sequoia, our mantra has always been to help the daring build legendary companies, right? And I think in the video, for those from Indonesia, they might have recognized William from Tokopedia and Nadim from Gojek. Like Search cuts across India and Southeast Asia. So you see some other founders here, Zomato founder, Oyo, Byju's, all successful and successful founders of large businesses. And over the years, we've actually helped many of these companies get quite large, being early investors in Google and YouTube and Dropbox, or in this part of the world, Traveloka, Zilingo, Funding Societies, or Modalku in Indonesia, etc. Right? Now, although we've worked with a lot of these larger companies, we've always been investing in seed and Series A as well, and actually heard from a lot of founders in these stages that they were going through a number of challenges. Right? Many of the seed startups were actually undercapitalized, didn't have enough money to actually build the business, hire the engineers, spend on marketing, etc. We also had a lot of founders that we met, and we were discussing Series A, and they've said, yeah, we raised an angel round, and then a syndicate angel, and then a pre-seed, and then a seed, and then a pre-A, and now we're talking to you. And so that experience is obviously suboptimal, right? Too much time spent, too much dilution over all those rounds, and often actually not the quality of investor or the quality of mentor that they had. And so that is when we started to set out and say, hey, is there something that we can do? Can we take a different approach? And that's when we launched Surge sometime early last year. And Surge, like we call it the rapid scale-up program. But if you think about it, right, what we're trying to do is engineer rapid early progress for startups by enabling disproportionate access to capital and talent and networks and company building knowledge that we have kind of like accumulated over 48 years since 1972 of backing companies that of which quite a few have become successful. You see some stats here, right? But we work with a lot of different founders from different countries. We often co-invest as part of the Surge investment. And I've actually invested quite a bit ourselves, but what's more important is that just Surge 1 and 2, these companies have raised over 300 million, within, frankly, the last year and a bit, which is quite exceptional. And if you look at the different cohorts, actually, let me talk about the cohorts. There's normally between 15 and 20 companies across all sorts of sectors, again, across India and different companies in Southeast Asia. Like Katabuk is a company that I'll talk about later on, but has become very successful, has already raised, I think, 85 million after Surge, and has grown really rapidly. Companies like Tilio in Vietnam or Koala in Indonesia, and Bobobox. Surge 2, again, we have a different range of companies across SaaS and B2B, as well as companies like Wukita in Indonesia or Paramart in Singapore. And Surge 3 is actually wrapping up as we speak with Upsurge, the Investor Week coming next week. So that's maybe a bit of context. Let's dive into the anatomy of a pitch, and let me actually start that off with a question. We'll do a few polling questions throughout this session. And the first one is actually like just kind of like testing your views. Like, what are the crucial components of your first pitch? And you can obviously mention different aspects, like all of it or one of it or some. But keen to get the views of the folks on the call. I'll give it a minute or so. Gina, let us know once some results are out. Oh, there you go. Perfect. Trick question. Like we're not that interested in the early stages in the exit path, and the valuation ask is also something that is a bit more delicate and it's not in the deck. Many folks ask us about that, which is why I put this in. But I'm glad to see that we have a very advanced audience here. Very good. Cool. So let's dive in, right? And like, maybe let me start off with a bit of a caveat, right? Like what we've tried to summarize, and we'll go into much more detail about all these, the 10 slides that you see here. The reality is there is no right or wrong, right? Different people have different flows. There's an eternal debate about team in the beginning or team in the end, or market in the beginning or market in the end. There is no right or wrong. There's different ways to approach this. And why I've proposed this in this way is that, they often say start with why, right? And as that second slide is a bit of an unusual approach. We focus in Surge a lot on storytelling, and that slide gives you an opportunity to hook the audience a bit more with some storytelling. So I'll talk about that in a second. But you start with why, like what has changed in the market? What is the pain point? That allows you to talk about like, what are you doing about that, right? What product are you building? What business model do you have? Once people understand that, they want to know, like, that's great, but how are you doing? What's your traction, right? Not just metrics, but customer love, many more things that we'll dive into. then people say, great, you might have achieved something so far, but if I invest for further growth and future potential and upside. So, the next question then is like, what's next, basically, right? And then lastly, like, people want to know, like, who are actually going to execute on that strategy, who are actually going to take it to the next level. And so again, this is a flow that works for me, that works for many companies that I've worked with. But again, there's different ways. The components of this story are very important, though, and they should pretty much always be there in whatever flow or structure you put it. The other thing I should mention is that what I'm talking about today is more like a full pitch deck. What we often see is, it's not always one slide per topic, but you might have a few slides on product, or a few slides on traction, or on some other things. So you might end up with 15 or 20 slides. For your Tech in Asia pitch battle, you obviously have much shorter time, right? So like, don't think that for that pitch you have to do all of this. That's a much shorter pitch, where you might want to crystallize out a few of these things, right? And combine it into one slide, or at least be more crisp, so to speak. So let's dive in. So it's actually interesting, like, sometimes we see folks have a title slide, and they start going off on all sorts of stories, but the audience still doesn't know what you're doing. So the simplest trick is actually, like, have just one declarative sentence that actually tells your audience what you're doing, so that there's no guesswork going on, right? It's harder than it looks. Many folks, many experienced founders actually struggle with articulating something in a very, few words only. And so trying to do that is actually quite important. And here it's done. Tiger Hall is a Search 3 company from Singapore, actually a few more words already, but at least giving people a view of what they're doing. Now, what I've done in this deck, I have the basic piece, the first one, and for everyone there's the 2.0, what's like next level, right? If you want to be a bit more special, I even have thrown in a few 3.0s that basically are over and above what the basics is, but the standard slides you'll see is the basics. So here a 201 is to not just say what you're doing, but give people a view of what your vision is, right? Where you want to go. Like Telio is a B2B commerce platform, as you can see, and they talk about their vision and their mission very early on, so that kind of like people know where the story is going. So normally a title slide, we don't even talk about it, but actually it's good to have some of these things at the start. And that second piece, right? And like I've titled it like what has changed, but if you think about it, in the beginning, you want to hook your audience, right? And there's basically two ways of doing it. One way of doing it is actually, I don't talk about it here, but is have one slide with some of your key numbers. So if you have crazy traction or a really interesting scale or something quantitative where you can throw some big numbers at it and people are like, oh, wow, this company's on fire, then that's one way to get people on the edge of their seat, right? Another way is actually to tell the story, right? And what's the narrative? And when you tell a story, you have to introduce tension. Like every story thrives on tension, right? So that often has to do with a shift or a change. Like what is happening in the world? What is the macroeconomic shift or the behavioral shift that you can see around you? And there's actually, other than that being an attention grabber, it has a secondary benefit as well. And that is your product might be a product or might be perceived as a feature or might be seen as something small. By tying it into a much larger macroeconomic shift, you're suddenly kind of like create much more of an aura of something that can be very big, right? And so what is the shift that's happening in the world? What is the threat or in some cases the opportunity that comes out of that? And what is that inflection point, right? And why that's important is because we've seen that the most enduring companies actually gain dominance because they have some sort of unique insight or unique understanding of a market asymmetry or an inflection point, right? So let's give some examples of that, right? One Search 3 company is called Pencil, and they actually have developed an AI platform that can create videos and visual ads from very simple inputs. And one of the things that they've said is that, which is really interesting, if you think about what has the biggest impact on an ad, it's actually creative, right? As you can see on the left, the ad contributes like 60% to the effectiveness of that ad. But if you then think about, so that's like value creation. But then if you think about where value is captured, the tools or the media agencies that are responsible for that like creative part of the advertising only have very little market cap. All the market cap is with the media, right? Is with Google and Facebook. Now, you might ask, why is that? Well, because they can offer a product programmatically with high gross margins, extremely scalable, versus the agencies is not scalable. So they're basically saying, hey, that's a massive asymmetry in the market. We offer a product that actually takes creative from that manual side to the programmatic side to a high gross margin software product, which could create a lot of market cap. So that market asymmetry is very interesting. And at least when they shared it with us, it got us thinking much bigger than we would initially have. Another thing is to not approach it from the asymmetry side, but from the why now side, right? What is the shift in behavior that you're seeing? And you know, that question is actually even more apparent right now around COVID, where we see a lot of so-called net new digital behaviors driving sometimes step change in adoption, like Zoom, for example. It could be a regulatory change. There could be an inflection point in technology or a drop in cost structure. Like when I was one of the first employees of AWS in the region, there was this so-called Cambrian explosion in startups because you didn't need 5 million to buy servers and infrastructure anymore. You can start a company and run on AWS for $10, right? In the early days. And so that's quite important. And like here's an example of that, which is from Katabuk, that basically said, hey, there's this large market of 60 million merchants, but they're now coming online for the first time. That's the main transition. That's the change that is happening. The why now for them, and I just talked about some shifts. There's one technology shift around connectivity. There's a regulatory shift, specifically in India. And there's a behavioral shift where merchants are now younger folks. They now have mobile phones. They're used to WhatsApp. They're used to Facebook. They're used to other apps. And it has created this unique environment for a product like theirs, which is kind of like a mobile SaaS for accounting for small shopkeepers, to actually emerge and grow really rapidly. So that why now is really important. And if you can, like, weave that into your story. Right? Now, there is a shift, but then the next question is, what pain does that lead to, right? In the case of Telio, one of our Search One investments in Vietnam, they actually started that pain point initially not at the level of the individual user, but a pain point in the market, much broader, right? In this case, the fragmentation in the market, the complexity of the value chain in between the brand or producer and the retailer, as you can see here, right? That actually leads to specific pain points for the buyers, like multiple suppliers managing that, pricing is intransparent, delivery is inflexible, and there's all sorts of issues around that, right? And so they start with explaining that pain point in quite some detail, right? Now, again, the 201 there is to really show an understanding of your customer. You can talk about that high level at the market level, but can you truly understand what that shopkeeper does, or what that individual user does, or what that student does? What is it that they have to do in their life that you're addressing? What are their so-called jobs to be done? What are the behaviors that they're showing? How does pain arrive for them, or what gains are they seeking? And one way to kind of like, encapsulate that is to actually think about user personas. And you're often impressed by founders that really truly understand their customers deeply. And I give you some examples, like Atlan, which is a Search 3 company, had this in their deck. They are actually a platform where data scientists and data engineers can work together. And they basically say, hey, there's actually a lot of people in a company working with data, right? There's the analyst, and he has certain jobs to be done. He prepares, transforms, and analyzes data. There's an engineer. He needs to handle the scale. There's like, in this case, 7 different roles or personas that each have a certain job to do. But then they also talk about, well, these guys actually have problems, right? The business manager just needs that data and can't get it. And DevOps engineer, has issues with running the data at scale, et cetera, et cetera. So they showed us a deep understanding of multiple people around that problem and that they can solve. An even more, nicely looking approach is what the Co-Learn has done. Colern is an ad tech company in Indonesia, part of Search 3. Different personas, in a nutshell, what they are, what the pain points are, what the blockers are, what their tech habits are, how they spend their time. We were super amazed when we saw this because it just shows a really true customer obsession and understanding much more deeply than usual what pain points you are addressing and what the customer cares about, right? So quite powerful. So once you've explained how the world is changing and what pain that leads to or opportunity that leads to, you obviously want to talk about your product. And it's actually surprising how often that aspect of the deck is actually underwhelming. We've seen, and even in companies that we invested in, you look back at the deck and you're like, hey, your metrics are great and your team is great in the market, but what are you actually doing? And actually articulating what you're doing at the product level. What are the features, or how can you paint a visual picture of the architecture or the structure of your product? It's not always done in a very compelling way. And we always urge founders to be able to articulate that product very clearly and articulate the product, how it's unique and differentiated, why you are the best to offer that. And in other words, your value proposition. And you can do that in here's the benefits of our product. There's also folks that propose specific, let's say, statements, and there's different formats for that, right? Like the simplest one is we help X, which is the type of customer, do something, which is your jobs to be done by offering Z, without actually going into the details of what benefits that delivers. It's very, very, very simple, as you can see here. You can also take a slightly more complex or comprehensive approach there. And you're addressing which customers, what they're trying to do or what they need, to who, your product, what it is, and the benefits, right? So, for small merchants who lose revenue opportunities due to a lack of inventory, our company's easy-to-use inventory management software helps simplify operation, avoid stockouts, and generate more money. So the last three are clear benefit statements, but this one sentence, is basically your one-liner pitch, right? And so articulating that clearly is very important. Now, there's one way that is even better than articulating it clearly, and that is showing it very clearly. The best thing you could do is actually have a demo. And, I'm in the midst of finalizing a search investment right now where the guy actually never really gave us a pitch deck. He gave us a demo, and then he went into all his dashboards, how he was driving organic growth and how he was measuring things. And we got the product, we got the growth, we've got the mindset was right, and it helped accelerate an investment there. But a strong demo can be very powerful. If not, at least be able to talk through and give a look and feel. Because in many cases, your investor, will not be the natural user of your product. And so give him or her a feel for what the product actually is like. Again, a picture says more than 1,000 words, like a demo or a visual explanation, like even more, right? So that's quite important. Then the next piece is business model. And what's interesting, often when we talk about business model, we just talk about, people just talk about the pricing. But when you explain your business model, what do you actually focus on? Do you focus on how you create value in the business, how you deliver that value, how you capture that value, or all of the above? Again, I'll give it a minute or so. Any results? Yeah. Yeah, again, very, very good audience today. In a way, you want to be able to capture all of that, right? And the monetization piece, again, is something that often is covered. But there's more than that. And so you want to be able to capture all these things. And in a way, how you create value could be seen as not just your product itself, but all the activities you perform, your partners, your assets, your go-to-market, and we'll talk about that in a second, is quite important. But then obviously also how you make money in a way, right? And so Tilio in Vietnam took this approach in their deck, where they basically said, hey, we actually have different models, and each model, here's how it works, here's the purpose, and here's how we actually make money. So the monetization is there. How it works is kind of like how they deliver value. Like what you see here on the left, this is how we optimize working capital, et cetera, right? So that's one way of doing it. If you go further, you'll actually focus a bit more on distribution, on your sales, on your go-to-market. That is often not done, but the reality is, when people talk about product market fit, which is one of the main goals that you're trying to achieve with your seed round, it's all about like getting that product to market. In other words, your go-to-market, right? What is your path to your first customers? If you're a B2C company, it might be your first 1,000 users. If you're an SME, it might be your first 100 small customers. Or if you're a large customer, if you focus on larger companies, like your first 10 enterprise customers. How are you going to do that? Like, what is your growth strategy? How do you land accounts? How do you expand accounts? Is there any unfair advantage in how you can reach your target customers, or maybe activate some sort of unique channel? I was chatting with a startup earlier this week that had set up kind of like a community and association, and through that had a lot of access to their customer base. And then they launched a product, a SaaS solution, and they actually have an unfair advantage because they can actually activate that channel. That's a proprietary channel that they've been nurturing for 2-3 years, right? So that's quite interesting. Now, again, this is one where we actually have a 3.0, and that is your business model mode. So I'm not sure who of you have heard of Warren Buffett, but one of the things he said is that the most important thing to me is figuring out how big a moat there is around a certain business. And what I love is a big castle and a big moat with piranhas and crocodiles, which I thought is an awesome visual image of how you build a moat. But that moat can take different forms, right? Sometimes it's network effects. So many marketplaces, or if you think about an Uber or Gojek, the network effects, like if I have more drivers, I will get more passengers. If I have more passengers, I have more drivers, and it's ultimately it's a winner take all or winner take most type of environment. You could also have a mode by very high switching cost, or by having such distribution and scale that it's very hard for other people to wedge in. You could have a very different cost structure than others, or have a unique experience, or someone like Apple that has just amazing brand and design. There are all ways in which you can build business models. We've had a whole session actually in Surge around business models, and after that, several startups in the cohort were talking about like these 5 or 6 modes that they were building. Like, you don't need 5 or 6, right? You need one really deep one, or maybe 2, 3 that somehow work together. But don't try and be all things here. Focus on depending on your business model, your product, your market. What is the business model that can be most powerful for you? Cool. Just take stock of where we are, right? We've talked about the why, like what has changed, what the pain point is, and about the what, in terms of what have we built in terms of product and business model. Once you get there, most investors will be waiting anxiously for, like, how's the company actually doing, right? What scale are they at? When I meet a marketplace business, the first thing I will ask is, what's roughly your GMV? Or what's your take rate? Or if I meet a SaaS company, I'll say, what's your ARR? And getting just 1 or 2 numbers early on helps the investor kind of like know where the company is in its life, how early it is, how late, et cetera, which is actually one of the reasons why sometimes, as I mentioned earlier, it's good to actually lead in one of your slides with a few key numbers, so that people kind of like don't get impatient during the rest of your story, but they kind of like know the high level numbers of the business, right? So the next thing you want to know is like, how is the business doing, right? What is working or what is not working? So let's zoom into that for a bit. Traction. Now, traction or momentum or whatever you want to call it, you can measure it in we often get this question like, do you invest in pre-revenue businesses? The answer is yes. We often invest in pre-revenue businesses. But revenue is only one way to measure traction, right? And revenue is a lagging indicator. Like, revenue will come when many other things go well. When you have a lot of customer love, right, with high retention, very strong user feedback, the likelihood that people are willing to pay for it and you actually making money are obviously much higher, right? So customer love is super important in the early days as a leading indicator. Very strong growth, like customers signing up, actually using it, actually engaging with your product, is very important. And specifically, that's driven in an organic way. Like we're actually looking at a company right now that has grown basically a global user base, completely organic with zero spend on marketing. But they have 200,000 MAUs, revenue growing quickly, people willing to pay, converting, all organically, right? So it's a very, very strong signal. Even if monetization doesn't kick in yet, if people are not yet willing to pay, or you're not even trying yet, you first focus on distribution, then that's okay. And that's why it's important what's here on the right is you just need one or two to start with. You don't expect to have and customer love and crazy growth and monetization. Like the way an investor talks about that is like we would need something to hang our hat on. We need one spike where we can say, hey, there's something special here. And that could take different forms, right? But talking about that is most likely the most important part of your deck, right? You might struggle to explain your market, struggle to make your product, but like if your pitch around your product is great, people think you'll have traction. If then you don't have traction, it's a bit tough. If your product explanation is actually not so good, but customers freaking love it, then the investor will say like, hey, maybe I don't get it, but the customer is paying with their time, is paying with their dollars, like they'll know. So I might not as an investor have understood the product, but that's my bad. I need to apply myself. There's clearly something special here, right? So that traction slide is super important. And again, many companies don't nail all of these. So you really need to think about where do I have strengths in this and where do I have weaknesses, and how do I engage in some level of data storytelling where I pick the right things that show the strength of my business and tell my story around that, right? And so, again, it could be based on all sorts of metrics. This is from Zenium, one of the Search One companies that saw app engagement go really high. Their MAU, WAU, and DAU were all growing really rapidly. At a rate or at a level that is much higher compared to similar products, right? Got that book that I mentioned earlier. Like completely went viral from the start. Like believe it or not, they now have 10 million merchants, if not more, and many of that organic through word of mouth and through just offering a good product, right? So by the way, see how simple this slide is, right? It's not a lot of numbers, but like the picture, it's pretty much in your face. That there's like what we call escape velocity. The company is just suddenly taking off, right? If that's not there, you want to show customer love. Again, this is from Zenium, and what you see is there are all sorts of data points, right? There's recommendation rate here. There's scores on being easy to use, on service levels. There's all sorts of ways that you can measure, like Net Promoter Score. We were recently looking at a company and they had a certain tool integrated in their website called Hotjar, which can do all sorts of analytics and check like heat maps of the site, but it could also do a survey. So we launched a quick survey with like 3 very simple questions, including Net Promoter Score. And within 6 days, we had 550 responses that we had direct access to. And we could literally see like who people had moved off of to join this platform and what their the NPS was, etc. And the customer love that we saw there with both qualitative answers, but also quantitative NPS scores was a main pillar of our decision to offer a term sheet to the company, right? One of my favorite is this one actually from Bobobox in Indonesia that again looked at all sorts of different platforms. They're measuring NPS. They're looking at the app rating. They had ratings on different platforms like Traveloka and Agoda and Ticket. And so across different platforms, they've been measuring the love for that product. And again, that was a key reason for leaning in and learning more and liking what they were doing. You can also go less star rating and qualitative, but more quantitative. And some of you guys might be familiar with looking much more deeply at the data. but we tend to look quite deeply at this sort of stuff, which is like cohort analysis and looking for each group of users on a monthly basis that have come in, like what percentage retains month over month, or how much time do they spend month over month, and see like what churn does to your business. And what you see on the right here is the difference between in growth rate, decelerate or accelerate, but also tapping out at 450 million on the right or versus 140 million. And that's the difference between 3% churn or what we call negative churn, which is actually like expansion for a SaaS company. So being able to show it maybe not with star ratings, but with actual engagement and retention is sometimes even more powerful. And then lastly, the 301 here is unit economics, and it kind of like depends on what type of business you are. But for specifically for any consumer product, e-commerce, D2C, direct to consumer, like having a deep understanding of your what they call PC3, which is a term that Rocket Internet uses a lot, and so many companies that have that background talk about that. But basically, your profit contribution 3, after all other costs, including marketing costs, etc., are taken off. Like having that type of view is quite important, and it could be in this way, or there's multiple ways of doing that. But showing that you truly understand your cost-based, your commission structure, your customer acquisition cost, and being able to show that even after paying your customer acquisition cost, there's a contribution at the unit level is quite important. And even more so now than it was last year, before the WeWork debacle and the poor IPO of Uber and a couple of other low gross margin businesses. I think the whole startup and specifically venture ecosystem have shifted a bit to be less lenient and forgiving when it comes to high growth but bad unit economic type businesses. Like back then, it was, basically as long as you were growing really rapidly, a lot was forgiven on the fundamentals and the sustainability of the business from an economics engine point of view. I think right now there's a bit of a shift. You see more healthy, high gross margin businesses like SaaS companies actually trade at much higher multiples, and you see people much more focused on unit economics and not necessarily profitability all the way, but at least healthier unit economics. So being able to talk about that is quite important. The reality is we don't see many people talk about these things. So maybe a quick test here, or question at least, is traction, as you've seen, is all about numbers. So for you guys, if you answer this, like we already have a good understanding of our customer acquisition metrics, our user and retention metrics, unit economics, or ultimately P&L as well, which I didn't cover here. And it's anonymous, guys, so please be honest. We don't see names with the answers. Okay. Quite a few. Yeah. Frankly, guys, it also depends very much on your business, right? Like customer acquisition metrics in a SaaS business, you might have 1 or 2 sales guys or 3 sales guys in the early days. It's still important, but it's less complex. If you're a consumer brand and you have your organic channels and your word of mouth, and you have your paid, and you have your social, and you have your referral, it becomes a bit more complex, and it's important to measure it better. But yeah, cool. So as I mentioned earlier, you might have identified a massive pain point in the market and a big macroeconomic shift that you're addressing, right? You might have built a great product and you're doing really well. But an investor doesn't just invest in the past. They obviously want to make, and specifically in the early days, they want to see a massive upside, right? Can this be a 10x investment, or at least a 5x, right? And so they need to be able to see the upside. I was just chatting with our team, and we had evaluated for 2 weeks, 3 weeks, pretty deeply a business that had been growing insanely well with strong unit economics has reached scale in a large market, and yet we decided not to invest. And the reason was that we didn't feel that that growth and those economics were sustainable, and we couldn't see a large future. And so being able to describe what the upside could be, how compelling your vision is very important, right? And sometimes we do a mind exercise, which I'm sure you're familiar with this concept of a post-mortem, right? Which you do after the fact if something has gone bad, right? What we do is a pre-parade, which we do before the fact if something goes really well, which is basically an exercise to envision what this company would have become if everything goes well, right? It's basically your dream case scenario. And why has it become successful? And so being able to paint that picture in the mind of your audience is very important, right? And one trick that one of our investors often does with founders after he's invested, he writes an email to the future self, right? And so this colleague of mine will write an email to the founders saying like, hey, it's been such a wonderful journey. You're now at this scale, you've made this impact, and at least in one of the cases where I've worked with my partner, this is Mohit Bhatnagar, those founders have pretty much, framed that email, and that's kind of like become their North Star a bit, right? Every now and then go back and see like, hey, that pre-parade, can we live that? So you want to show that vision. And when we talked about traction earlier, we said, hey, it's okay to not monetize. That's one of these things where you say like, hey, we might do this right now, first layer for distribution, but then this is what we can do next to get more sticky, and this is what we can do to then monetize, etc. And painting that vision is quite important. And Kaptabook did that really well, right? Where they basically say, hey, we're doing all these things now that are there to drive engagement. Then we do a number of things that generate data, and then we do a number of things that actually monetize. And once that vision is clear and that direction is okay, and people like the growth in those first layers, people actually have investors often have a lot of patience when it comes to monetization. So if you look at an app like Carousel in Singapore, many board meetings, there were conversations going on around, shall we monetize, or shall we focus on building more supply and more demand and avoid the friction of monetization? And many board meetings, the answer was, let's continue to focus on liquidity on the marketplace, transactions, and once we have a higher scale, we'll start monetizing, which they've now done. And I think they've just announced a very large raise at a pretty high valuation, but takes a lot of patience to go through these different layers, right? The next is market. And again, market is often seen as one of the most important things. And that's why some people prefer to start with that, which is also fine. Don Valentine, for those who don't know, is actually the founder of Sequoia Capital. He was an early pioneer in Silicon Valley, working for Fairchild, where the first semiconductor was actually launched in 1959. And he was then one of the first to launch a venture firm, which was Sequoia Capital. And he's known to be a big better on markets. And so one of the things he's saying here is we've always focused on the market, the size of the market, the dynamics of the market, the nature of the competition. And this statement of great markets make great companies is just very important. And one of the things you often say, like if you pitch a great founder against a bad market, the market will win and your company will be tough, right? And so thinking about market is just exceptionally important. It's market size, obviously, and potential adjacencies if that core market is not big enough. It's also the growth of that market. And one thing we actually focus on a lot in Search, also where we run a dedicated session on this, is industry structure. So when you saw the slide from Tilio earlier on the third or fourth slide on pain, he showed a picture of the inefficiencies in the market, right? The complexity and fragmentation and the different layers. So understanding that fragmentation and complexity, understand how that's hurting either the supply or demand side or the customer. Being able to understand where revenue pools are, where margin pools are, is ultimately very important. So just saying it's a large market. Like I once was discussing with a company and he said it's a really large market. It's great. Can you paint for me the value chain? And he did. There were 4 or 5 layers. And I'm saying, okay, which layers are you taking out to generate a revenue and margin pool? And he says, no, actually, I'm not taking anything out. I'm injecting myself in. I'm like, okay. So in a value chain where the margin, the all available margin pool already has to be spread across 4 or 5 different layers, you're injecting yourself in, and then how are you going to extract margin? And we ended up not investing in this company, but we caught up 3 years later, and like there was lots of top line growth and there was lots of things that had gone well, but the company was still not making any revenue because they couldn't extract value, right? So they could create value, but they couldn't capture it yet. And that had a lot to do with that industry structure. So thinking about that is quite important. You can do that top down, but many investors are kind of like allergic to this concept of like, oh, it's 10 billion, we only need 10% and we're like $1 billion company, right? That's very easy to say, very hard to do. So what's sometimes better is think bottom up and think about the very simple P times Q, price times quantity. Price in this case is the value you get on a per customer level, right? And so we often ask ourselves this question, like, what do we need to believe for this to be a $100 million revenue company, right? Like, can we do the math somehow? And in a way, this picture is quite known. That basically says, hey, there's 5 paths towards a $100 million business. In my mind, I often simplify it and realize that the first two, the flies and the mice, as they call it, where you get either $10 a year per customer and you need 10 million customers to get to 100 million revenue, or the mice where you get $100. Those are kind of like your B2C, right? If you are paying like $8 for Netflix or for Evernote or for Dropbox, you're about $100 a year per customer, and you're a consumer play. As soon as you start looking at the $1,000 mark per year or 10,000 per year, that's more your mid-market, right? $1,000 is like $80 per month. There's not many things I pay $80 per month for as a consumer, but that's pretty normal to pay as an SME for software, right? Or if I'm in the higher end of the software, I might pay $800 for something if I'm a company with 100 employees or whatever. And so that's your B2B SME mid-market play. Or if you're in the enterprise space and you're a so-called elephant hunter, you go for the large enterprises, right? You get DBS as a customer, or you get HP as a customer, or you get Unilever as a customer, and you can charge them a lot more if you provide a valuable service. But being able to think in that bottom-up way is quite important. And even so much so that sometimes, at least if you want to convince me, a very detailed 5-year forecast with hundreds of assumptions, etc., is less impressive and less compelling than a very simple back of the envelope where you basically say, hey, we think, and this is what we saw in one of the decks, for example. There was a company that says, hey, right now we have 488 customers, and we think we can get it to 10K, right? And we're charging around 3K right now, and we think we can get that to 10K. And basically that means that in 5 years, we need a 20x uplift here and a 3.5x there. And here's actually the growth drivers and how we think we can do that. And we actually looked and we noticed that some of the customers already were at the $10,000 level. And that gave us a lot of reason to believe that they could do this. So this is what they call a deer hunter. The deer is the $10,000 per customer, and you need 10,000 of them, right? And in their deck, they talked about this. And again, it was part of what gave us conviction to actually offer a term sheet to this company. Not announced yet, so I cannot say who it is. We're getting to the end, guys. The last thing, or one of the last thing here, is your competition. It's always good to talk about. Like I'm actually a bit brainwashed in Amazon. In Amazon, we always say never talk about your customers. Or at some stage, they basically said, well, you know what? It's good to understand them, but obsess over your customer. That's where the main focus should be. But when you understand them, you want to understand your direct and your indirect customers. You want to understand the alternatives. What's the status quo? What happens if they don't do anything? At some stage, I was we were chatting with someone in Unilever, and he was talking about who competitors were. Sorry, got it wrong. Someone in Barty, telco, right? And talking about who the competitors were. And at some stage, he talked about Unilever as a competitor. And we say, hey, what do you mean? He says, well, young kids, they're 15, 16, they can top up or they buy ice cream. And so if you look at the competition over the budget, it might not be a direct competition. It might be a completely different category, a different product that they go for. So be mindful of what you compete with and how you just, it's not just like, oh, Barty is better than, or Telkomsel is better than this one or that one. It is, how can you make sure people choose your product or your category over something completely different? So like an indirect competitor. And so being able to think about how you're different and not just better, like how are you beating that competition? We've all seen the four quadrants. It's very worn by now, and it's not a very compelling way to talk about your competition. So I'd urge you to innovate on that approach and show a deeper understanding. So, and then lastly, team, right? What I often say is even if you don't have a slide on competitors, you basically say, here's the future, here's what we're going to build, and here's the team that's going to execute it. You want to show that you're A+ founders. We talk a lot about product market fit, but you also want to be able to show what we call product founder fit, right? Show that you as a founder are unique in doing that, right? Have a unique understanding of that market, have a unique approach. And like when we invested, for example, in One Championship, the founder there has been a lifelong trainer in mixed martial arts himself, had set up a school called Evolve of mixed martial arts training schools, had a business degree from Harvard and spent time at hedge funds, etc. So was commercially and financially savvy. And so setting up a very large sports franchise in mixed martial arts, he literally said, like, I realized that in Asia, there's no one better that could do that than I. And he could explain why, and people believed him, and we still do, right? And so product founder fit is important. It also sometimes helps to talk about the joint history, right? Like, did you just meet like yesterday somewhere in a bar, or have you been working together for a long time? And sometimes it's good to actually show a strong second level, like other than the founders, right? So this is one of the companies in Search as well that could actually show that the next level, not the founders themselves, but the VPs of engineering, operation, growth, had really relevant experience at relevant companies. I liked how they kind of like brought out the key transferable skills and what they build expertise in. So that was very valuable. So with that, we've covered the 10 main topics that make up for the anatomy of a pitch. And I think we'll now go into Q&A. And I think there's quite a few questions
yeah, we
there
have
as well.
a lot of questions for you, Peter. I'm gonna start and moderate the questions. So first, I'm gonna ask a question on this is about enterprise startups. It mentioned that unit economics tend to be very high because of the time and effort required. Does that put off VCs like Sequoia when an enterprise company pitched them?
Let me maybe correct the premise there. Like, unit economics is the name for like how you look at the commercials of your business at the unit level. So you can't say unit economics are high or low. You can say they're good or bad, right? But some of the metrics that you look at from a unit economics point of view, high is better. Sometimes low is better. Actually, in enterprise startups, normally you actually monetize sooner. And so the gross margin tends to be high, which doesn't put us off. We're super excited about high gross margin businesses, right? And so the structure of B2B businesses or software as a service businesses is such that you normally monetize from day one, specifically if you charge enterprises. And as mentioned, you might go for the 10K a year, 25K a year, 100K a year type accounts with higher gross margin. So the unit economics tends to be better and easier, and we like that, obviously. So quite a few B2B businesses that we have invested in and that we'll continue to look at. Hope that answers it.
Awesome. All right. Here's another question. Peter, could you give examples? In particular, you referred to switching costs when we were talking about moats. Some of them just weren't clear on that. Maybe you can give some examples of switching costs.
Um, yeah, sure. Like one example is like I used to work for Amazon Web Services, as I mentioned, right? And the concern customers sometimes have with them or with Google or with other is that once I commit myself to AWS and I start writing code that integrates specifically with their services, that switching away from this product is actually very costly and will take me months of migration and high cost or consultancy, etc. So switching cost is basically, can I build in such a stickiness that it actually becomes really hard for someone to move away, right? Maybe give you another example. If I've bought a lot of apps on the App Store and on my iPhone, if I buy a new iPhone, um, I get to keep all these apps, right? I don't think that's the case if you switch to an Android. So you might need to buy apps. You definitely have to install things again. And the switching costs are actually quite high. One other example in that same light is back in the days used to always work on a Microsoft computer, right? And then move to Apple. There's actually switching costs from a training point of view. Like just getting, like everyone was raving about how easy and user-friendly a Mac was. But when you had been spending 15 years working on another device, the switching costs are actually in the training and onboarding, so to speak. So there could be all sorts of factors that make it hard to move from one product to the next. And that basically means like, oh, I'd rather stay with my iPhone or I'd rather stay with my Microsoft device or whatever. People won't move away from that. And you see guys like Microsoft and others basically hone in on that by giving free software to university students. They want to get people early because they get used to it, they get trained in that, and actually changing to something else would be huge switching cost for engineers to suddenly move away to other software and have to start the whole learning cycle again, right? So hope that clarifies that one.
Awesome. Thank you so much. All right. The next question is, for this TIA competition, we need to do the pitch in 5 minutes. How would you change your pitch for such a very short amount of time? Anything in particular that you should focus on?
My honest answer is that I kind of like hate these 3 or 5 minute pitches, but at the same time, they're a great exercise in like really crystallizing out your story, right? There's this famous anecdote of a British author, T.S. Eliot, that wrote a 12-page letter where he started with, "I apologize, I didn't have the time to write you a shorter letter," right? And it's kind of funny, but actually being able to crystallize all the complexity of your business into a few slides is really hard. Like in the 3 or 5 minutes, I would focus less detail on the business model in detail. I would focus less time on competitors. I would really say there is a huge market. We have an amazing product. There is huge customer love and traction in whatever form, and we have this amazing team to attack this market. Like specifically in seed, it is often market, founder, product, and momentum. And so those are the 4, if out of all these slides, those are the 4 that you want to hit hardest on.
Thank you. All right. Moving on to the next question. Peter, thanks for doing this session. Wanted to ask how we think about business models if our product does not have monetization yet. Should we approach it differently?
No, you should not necessarily. Again, I think Twitter listed at, I don't know, 10 billion, $20 billion market cap. I forgot the price when they listed, but with 0 revenue, right? And so many businesses that we have invested in didn't have revenue. And the example I gave around Carousel was a similar example where actually we delayed monetization for a long time. Now, one caveat, why we did that in Carousel is that we knew that there was a playbook. It was almost like a classified, and we knew how a classified could start going for paid listings or could start going for take rate, or there was a playbook like broadly in the industry around how you monetize that. I also serve in the board of another company that has crazy distribution, but the playbook wasn't there, and it has actually struggled to monetize. And so it depends on what type of business you're building. but I would at least indicate, like Katabuk was doing on that slide. It says, here's how we're building distribution, here's how we're building data, and then this is a model for building monetization. They didn't specify whether that's 1 year out or 2 years or 3 years, but there was a very clear vision and approach that people felt like, yeah, we can see that happen. We can understand that once you have that distribution and that data, that you can bring in a new layer of monetization. So not having monetization right now, no problem. At some stage, it will become important. Think about it early so that you can say, hey, we're not sure yet, but here's 2 or 3 options that we think are viable, and build some level of comfort around that.
Awesome. How would you evaluate first-time founders or founders that don't come from Ivy League? In particular, I guess with the team slide.
Yeah, it's a good one. So again, we invest in many serial entrepreneurs, but we also invest a lot in first-time founders. And I don't think Jeff Bezos founded a company before he founded Amazon. The same with Mark Zuckerberg. So I don't think that's necessarily a problem. If you don't have, let's say, pedigree in terms of education or whatever, it is important to show that product founder fit, or make it really personal, right? So if you look at William Tanuwijaya, the founder of Tokopedia, which is one of the largest unicorns in Indonesia, he came from a very humble background. I think his dad was a factory worker in Sumatra. Had to save up to get a ticket on the boat to go to Jakarta and pay the first year in college. His dad fell ill. To make it through, he had to work in an internet cafe. That's where he learned to code. And then when someone said, like, hey, this e-commerce thing is coming up, I want to be able to sell my goods in some of the further away islands, can you code me something? He did that, right? And that personal story he shared, and the fact that he cared deeply about Indonesia and about leveraging internet as a tool for the people, there was a very, very strong ideology and a sense of purpose and a sense of mission. So when you lack, when you're not a second time or third time founder and you don't have pedigree, like, hone in on your personal story, your deep passion for solving that problem, your deep understanding or insights into that, and that becomes more important. But you want to still build a level of comfort around you as a founder, right? And there's different ways of doing that. So yeah.
All right, thanks for the answer, Peter. If a startup has been fundraising for a while, does it affect the attractiveness, or the startup's persistence and agility is basically being tested?
Sorry, I'm not sure if I fully understand that one.
Sure. It's basically, would you prefer if a startup, for example, has been fundraising for a while, and it hasn't raised fund, does it affect its attractiveness to you as an investor?
The answer is, the honest answer is, it shouldn't, but to some extent it would. And let me try and explain that. As an investor, we are constantly testing ourselves and telling ourselves how important it is to be independent thinkers. And many times we've made investments that are based on that, are based on independent thinking. At the same time, you are constantly looking for signals, and all the data that we ask about are signals, right? Customer love is a signal. Certain data in the retention are signals. They're all signals that help you build conviction and that help you in your thinking about something. Now, the reality is, whether many investors will admit it or not, is that one of the signals is also whether the company is hot or not, whether other people love it or not. And so when you've been out in the market raising for 6 months and no one has found the business attractive enough, I wouldn't say that it's a massive deterrent, but you will ask yourself, like, hey, like, why is that? Like, is there something I'm missing? Like, I might like it based on the deck or based on the founder, but is there something wrong? And so it could be seen as one of many signals. So that is something to keep in mind. So, like, I would think carefully around that signaling. Like if you said, if you're saying like, hey, I've been, pounding the pavement for 9 months, but no one wanted to invest, that's not a great story. If you say like, hey, I've started to build relationships with with investors for a while, and now is the time. Or you said, hey, I've started to do that in anticipation of an inflection point and traction kicking in, and look, we've just hit inflection and we've now started to grow. Then again, the storytelling there becomes important, because again, it can be seen as a negative signal if you're basically telling people like, hey, I've got an amazing business, and everyone says, everyone is not interested. So think about how you craft the narrative around that. Again, very honest
All right.
answer.
All right. Thank you so much. That was a really, really good, honest answer. I'd like to ask the next question. How do we benchmark ourselves in terms of cohort and retention? If our retention isn't great yet, should we even mention it in the deck?
Is a good question. If it is not great, but there's an upward trend starting to show, then you could show that, right? If it is just terrible, I wouldn't focus on it. Again, I mentioned earlier that the data storytelling is important, so pick the data that you want to highlight. But data without context is pretty useless. So even if it's low, if you know why and you know what you're doing about it, like we don't like, again, I'm giving all sorts of very honest advice about how to manage some of the optics and how to position things. But we're pretty allergic to founders that are overselling. There's a big culture within Sequoia that's around get real. And even our internal updates within Sequoia around companies are not like, oh, company that I led the investment on is doing great. We're very, very honest, intellectual honest about how things are going. And we always try and have a fair dose of get real. Like, hey, here's the things that are working, but oh boy, this is tough, or this is where the company screwed up, or here's where we made a wrong strategic choice, or we're very honest about that. And so in your pitch, we actually value it if you can say like, hey, this is going great, but you know what, this isn't working yet, or we haven't figured this one out yet, but this is what we're doing about it, or what we've analyzed. It needs to be a balance. Like if all things are not working, it becomes a bit problematic. But if there's clear strengths, but obviously there's some weaknesses, then that can be the case. And being able to explain why and your deeper understanding of that problem and what you're doing about it can help. And then you can talk about it. Like I wouldn't have a full slide saying, here's my cohorts, they're terrible. But when you talk about products, say like, hey, people love it, and we have some amazing power users, but across the entire base, retention is actually quite low and our cohorts don't look great. We think that we've maybe focused on the wrong customers, or we still need to launch this one use case that is a high frequency use case. Now it's not coming, so people forget about it. So we're working on that, and we're launching this high frequency use case, et cetera, et cetera. So a story like that is perfectly fine and actually shows humility and vulnerability and honesty, which will be much appreciated, frankly.
Awesome. All right. The next question. Can you share some insights into how seed stage companies can structure their cap tables, and how would you talk about this during the pitch?
That is a really long, tough conversation. And frankly, you don't talk about it during the pitch. Your initial 5-minute pitch has nothing to do with the cap table. It's purely selling, right? And literally pitching, right? What you want to get is an investor to say, hey, we want to meet for a full hour with you, and we want to hear the full story, right? Let's catch up afterwards, right? Then you give them a full pitch. Even then, you're not talking about your cap table, right? It's only when you get much further in and much deeper in the conversation that, like, actually, I was sending a term sheet to a company today, and only yesterday I asked them for the cap table, right? I knew roughly how much the founder owned, and that there were 3 others that owned some part of the business, but it doesn't play a role in the investment decision. Only if the cap table is completely screwed up at some stage will it be, can it sometimes throw a spanner in the works. And I'm actually working on another investment where that was to some extent the case, where it was very complex, and the whole diligence process and getting ready to take our investments required some cap table restructuring that we've worked through. But if you lead with like, oh, we have a very complex cap table, like you're scaring people off, I would just focus on like get people excited in the business. And in this case, we got so excited about the business that once we realized that the cap table was an issue, we were more than happy to work with the company during diligence to overcome that and fix it.
Amazing. All right. I think the next question is, what's the right level of monetization? Uh, at what point can we say that we are high growth?
So first of all, there are two different things, right?
Mhm.
Like monetization is literally whether, other than creating value, that you're capturing value and then people are paying for your service. Growth could be on a lot of metrics. Like there's companies that have crazy growth when it comes to downloads. But maybe many of the downloads actually don't become monthly active users. If you do better, they become monthly active users. You say we have crazy growth in monthly active users. You can say I have crazy growth in daily active users, or in content consumptions, or in app opens for B2C companies, et cetera. There's all sorts of ways, again, to show that an aspect of your business is growing, even if there's no monetization yet. When you talk about monetization, like the main metric is obviously revenue. Like how's your revenue growing, right? But depending on your business, that might be super important in the early days, or it might not be that important yet. And so that's I guess the answer.
Perfect. Thank you so much. All right. I think this is a more question about pitching. Is there a difference in how you would pitch an industry changing play? So something that you've never seen before, where the playbook you've never seen before, like Airbnb, versus something where it's a little more straightforward, there's a playbook to it?
Yeah, I think it's actually a super interesting question, and another question I get a lot, but it's actually really interesting. Like I started this session by talking about how many pitch decks we've seen, right? Now, to basically cut through the clutter and quickly make up our minds to see whether we like something or not, we would do what any human being does in a social setting, and that's stereotyping, right? We're trying to pigeonhole something. And so if I see a company that is a SaaS company, I understand SaaS. I've made a lot of SaaS investments. I quickly know which things to ask for. I quickly know how to understand it. And I can pretty quickly get to the core. Same with a marketplace business or with a certain type of fintech business. If you come with something truly unique, it'll take me more time. And it'll take most investors more time. Like last year, together with a colleague, led an investment in a quantum computing business. That the product isn't launched yet. We didn't know the go-to-market yet. Lots of unknowns in a very complex technology where the founder was a double PhD, if I'm not wrong, from some of the best global institutions, and one of the smartest guys I've met. Not easy, right? And so you need to really apply yourself from our side. From your side, you need to be really strong in educating, right? The storytelling part, painting that picture, making something really complex, really simple, becomes super important. And it's super hard, and many founders are not great at that, to be perfectly honest. It's a skill that you need to acquire. But know that if you're unusual, one is try to see if you can help people triangulate. If you say, like, I'm not exactly this or that, but like, actually, I'll give you one example. About 5 years ago, there were a lot of businesses that had software tools and some SaaS components, but then were monetizing with transactions. And I started seeing a lot of those founders, and the founders struggled to explain their business. And I struggled to explain it, to understand it. And which metrics should we look at? How should we focus on the business? And then this new body of material and thought leadership started to arrive around so-called software-enabled marketplaces. And some of those articles laid out, and I literally had founders like, now I get it. This is what we are. This is the animal that we are. We didn't know how to name for it, but now we have a name for it, and we understand the dynamics. And now we can explain it to people. And suddenly a lot of things clicked. And then when I started seeing new businesses in that space, I was like, oh, it's a SaaS-enabled marketplace. Ah, okay. Are you this type, that type? Should I look at it in this way or that way? And suddenly it became easier. So two things: one, storytelling and education. B, try and find parallels that allow an investor to triangulate. Like we're new, but we are a bit like this or a bit like that. Here's a way of looking at it. Like help them frame it, basically.
All right, that's a really really good question. I think the the last question we get is around will the winner of the pitch battle will be considered into the search accelerator? Yes, you will be. We will be putting you under consideration. All of the search judges, including Peter here, will be there at the regional finals. So super excited to have them along. And with the question on like will we be able to get a copy of the slides? We won't be putting the slides itself out. However, we will be posting the video on YouTube. So stay tuned. Stay tuned on the Sequoia India YouTube channel. We'll post some of the videos there. All right, that. Thank you. With that, I'm going to wrap up this session. Do you mind putting up the slides, please? Thank you so much. No, I'm asking. Yes.
Okay.
So thank you so much for attending this session. Obviously, Surge as well as Tech in Asia. This pitch battle is pretty much just like a startup. Any bit of feedback will be really helpful for us to improve at our next event. So do check it out. It's in the chat. Just click it and then follow along and fill in the feedback form. And then next, we're running a lot of webinars. We run a lot of our events. So next slide, please. So just make sure that you keep track of any of our social media, whether it's Twitter, Instagram, LinkedIn. You'll get the latest news on what's happening with Search, and you'll get to access all of the webinars that we are currently running, as well as any new materials, any interesting thoughts that we are putting outside. And lastly, the next slide, please. The search application will be closing on September 18th. On top of that, the Startup Arena pitch battle the registration will be closing on the same time as Surge. So if you have any friends, do ask them to both sign up for both the Startup Arena pitch battle as well as Search 04 application. We really look forward to reviewing all the investment team. We've been working really hard to review all the pitches one by one. And with that, thank you so much. Thank you, Peter, for taking the time out of your busy schedule.
Thank you so much, guys.
To do that. And we see you next time. See you guys.